The group on pace for their worst year since 2006 as interest rates and the troubled commercial real estate market pressure the sector. Joining us now for a deeper dive is KeyCorp CEO Chris Gorman, presenting tomorrow at the Barclays Global Financial Services Conference. It's good to have you back on, Chris. Welcome.
Well, thank you, Sarah. It's great to be back on.
There is this lingering fear about profitability and regulation and just the business models for regional and super regional banks like yours. Are the fears overblown?
I think so. I think part of it is just the uncertainty. You know, the NPR came out just a couple months ago, and people are just digesting what does the model look like going forward? How much capital will people have to carry? What will be the cost of that capital? And I think the banks will be able to adjust. I can speak for Key. We have a variety of ways to generate capital organically, which we're currently working on. I think the business model going forward, Sarah, is going to be one that's a more asset-light business model. There'll be a lot of focus on underwriting and distributing securities. There'll be a focus on businesses like wealth, businesses like payments. Those are the kind of businesses that I think will make a lot of sense in kind of the path forward. The other thing that I think you'll see from the banks is lower loan-to-deposit ratios, because ultimately the ability to grow will be based on the granularity and the quality and the duration of your deposits. So there'll be changes, but I'm confident that bank managements, as we always do, will adjust.
Speaking of deposits and some of those nagging fears from March and SVB, the Fed has continued to raise rates. And there's still some uncertainty whether they will continue to do so. And we've seen so much money flowing out of bank deposits and into money market funds. Is that still happening?
It's really slowed down. In the second quarter, for example, Sarah, we ended the quarter with $1 billion more in deposits than we went into the quarter. I do think, though, obviously higher rates do have an impact. As you know, because we've talked about it, I've felt for some time that rates were going to be higher for longer. I still believe that to be the case. And I think there's still some impacts that the economy's slowing down, but there's some impacts that I don't think have even hit the economy yet. For example, the fact that the banks aren't lending as much. I think the notion of the Fed shrinking the balance sheet, the $8.2 trillion balance sheet that's being shrunk by about $117 billion a month, that has an impact. You could have a scenario where Fed funds rates actually are flat, but interest rates are still, going up a bit. And the last thing is just there's really a lag effect. We've had a lot of monetary action in a short period of time.
So that's the case for the Fed stopping to raise rates now and potentially cutting into early next year. What you mentioned first, the tightening in the economy from bank lending slowing down, and I want to dig into that with you. How much is it slowing down? Because there were fears post-SVB that we would see some type of credit crunch. It doesn't feel like that really materialized. What are you seeing at Key?
Well, there's certainly not a credit crunch, but clearly as banks have to carry more capital and capital is more expensive, what you're going to see is banks organically not lending into non-relationship type situations. So you'll see banks shrinking their loan books. We've talked publicly about the fact that we will shrink our risk-weighted assets because that's probably the easiest way to generate capital organically. So relationship clients will always have a lot of access to capital, but some of the people that have been borrowing that had sort of non-relationship borrowing only kind of arrangements with banks, I think they'll find it a little tougher going forward.
On the profitability front, what's happening with deposit costs? They've obviously been rising as rates have risen. I know you had to lower your forecast for net interest income last quarter, I think down 13%, 2023. Is that still on track? How does that look?
Yes, we're on track. We gave guidance at the end of the second quarter, and we're on track for both the third and fourth quarters of where we are. And what we've seen is the deposit betas are slowing. And so we had a cumulative deposit beta of 39% at the end of the second quarter, and we have targeted kind of a 50% cumulative deposit beta. So we are seeing a slowdown in the rate of deposit beta increase.